It's really nice to see you guys. A lot of old-time colleagues. This is great. Thanks for inviting me to present this paper. You might hear background music. I didn't plan this, but apparently BC is having a party for the undergraduates end of the semester, and it's right out there. So if you hear something in the background, I apologize. So let's talk about this paper. We're going to try to investigate here the impact of retail traders on the market. I think it's a big issue now. I think it started before the pandemic, but the pandemic escalated it, and I think we've seen even post lockdown, we've seen what happened in January with GameStop and short squeeze. I think for a long time, the profession has thought, there's not much participation. How come individuals are not participating enough in the market? There were a lot of different explanations. Maybe it's risk aversion, maybe they don't understand the financial markets. And I think what this paper shows is maybe they didn't have enough time, because once they had free time, they started participating. Now, in addition, in the last decade or so, we've been witnessing a significant development in fintech technology, and in particular retail trading platforms that what they do is they allow easy access for individuals to participate in the market. And they also reduce trading costs, and as a response, also legacy platforms like Ameritrade, Fidelity, Schwab, all of them reduce fees. And now we're in a situation where it's easier for individuals to participate in the market. And so what I want to talk about is some benefits and what we've seen earlier this year, some potential adverse effects or consequences of their participation. So what I'd like to investigate here is the impact they had on liquidity. And I think the pandemic really gave us a unique setting. Why? Because it's an interesting situation. People had to stay at home during the pandemic lockdown. So you're staying at home and there's nothing to do, no entertainment. There's no sports, no sports in America. What are you going to do? So, thank God the market was open so you can do something and you can look at some numbers moving around. Let's see what it means in terms of, I mentioned people stayed at home in lockdown. This figure here, you see here plots the mobility score. So Apple has a mobility score. They started this actually January 2020, great timing. And they measure the amount of searches for directions, travel, directions. They want to see how many people are actually moving around. And what you see here starts at 100 back in early January 2020. And then you see these blue bars are just showing you as a percent of 100, how the mobility has changed over time. And you see there's increased mobility at the beginning, and then there's a drop mid-March, significant drop. This is a 7-day moving average. So actually there's one single drop on March 16, a drop of 25% in 1 day in mobility. And then you get into this situation where there's a period of low mobility, and that goes up until May 7th. On May 8th, the level of mobility is about back to 90% of where it was pre-pandemic. And so what we're going to do for the study, we're going to take this time period of January 21st, 2020 through June 10th, 2020. We're going to divide it into 3 separate periods. The first period is the normal period. Okay, so this is through March 15. Then March 16 through May 7th, that's going to be our lockdown period. And then there's a reopen period from May 8th and on. And what we're going to investigate is how people traded and what that has implications to stock liquidity. Another variable that I'm going to be using is media coverage, and I'm going to try to understand whether people respond to what they see in the media. So the graph that you see, or the line on this graph, represents the percent of articles that are COVID-19 specific for the entire universe of firms. So the universe of firms we're going to be looking at here is the Russell 3. And what this line shows you, that about 75% at the peak, it's just about below 72% of all articles that came out on the Russell 3 firms were concentrated on the COVID-19 pandemic. Now, the chances that a firm is going to be mentioned in the news is 17%. So of course, not all firms are mentioned, but if you look at all the articles that are mentioning firms, 75% of them at the peak were about COVID-19. So we're going to try to see whether there's some kind of media attention or investor attention to media that introduces some extra trading. So what happened? So people stayed at home. And what I'm going to argue here is that they stayed at home and traded. So we looked at Robinhood data. So there was a website that's no longer there, Robinhood Track, where you can actually see at the end of every hour in the trading day, you can see how many unique trading accounts or on how many unique trading accounts per firm existed on Robinhood. So we look at that snapshot at the end of the trading day every day. And what you see on this graph over here is the average number of unique trading accounts for the average firm, the Russell 3000 over the time period. And what you can see is around the lockdown, the start of the lockdown, there's a significant increase in the number of unique trading accounts on Robinhood. I think it's interesting at the same time, you can see a significant outflow of capital out of US equity funds in the US. It's about 200 billion. So there seems to be, maybe there's some kind of substitution effect. People took money out of their out of the mutual funds and then traded individual stocks on Robinhood. Now, when you look at how the market liquidity looks like around this period, I thought it was interesting to compare the financial crisis that we all remember in 2008 and 9, compare it to what happened now in the pandemic. So what you see here, this is the SPY, all right? This is around the financial crisis. And the bars are the average effective spreads, the average effective spread for the S&P 5, because I'm looking here at SPY, I'm looking at S&P 5, I'm looking at the average effective spread. In the financial crisis, I don't think you can really say much. I mean, there's a few jumps in illiquidity. So this is average effective spread. The higher number means less liquid. And after that, the market dropped. It's continued to drop, we know, for a few months before it started going up again in March 2009. The pandemic looked very different. There's a drop for about a month. Illiquidity went up. There's a sharp increase in illiquidity on that Friday, March 20. And following that, there was liquidity improved and went back to almost normal period, to pre-pandemic levels pretty quickly as the stock market recovered. What I'm going to try to argue, because I'm going to look at the cross-section of firms, is what happened is at this point, individual investors came in and provided liquidity to the market. All right, so how am I going to do this? Well, first, I'm going to show two types of results. First, I'm going to show you what explains retail trading. So I'm going to look at retail trading as my Y variable. I'm going to try to explain that. And then I'm going to take that number and try to explain liquidity. So what you see here is on the explained variable here, the independent variable, the dependent variable is the log number of accounts on Robinhood. This regression is going to be run by day. It's going to run at you have a data daily per firm. We're going to compare the normal period and the lockdown period. So we're going to have a dummy for the lockdown, which is the March 16. And what you can see here is very simple. What you see is that there's a significant increase in the number of trading accounts on Robinhood during the lockdown, right? You see it right here. By the way, if you're interested in understanding what individual investors trade, it seems that they respond to short-term price momentum. So P-RET is past return, is a past 1 week return. It's positive. It means that they're buying, they're short-term momentum traders. When you include media coverage per firm, again, I said about 17% of them on any given point have some media coverage. It's not significant before pandemic, but during the lockdown, there's a significant attention to media. So there's more trading, or more trading accounts. It's not exactly a measure of volume. It's like the number of trading accounts. It's a weakness of the study, but there's more trading accounts as a response to media coverage during lockdown. Okay. When the states reopened, and we're using here May 8th as that variable, when states reopened, so what we're going to look at now is we're going to compare lockdown versus reopen. Okay, so we know that there's significant, so what you see here is that there's significant trading on Robinhood even after reopen, because that trend has continued. But the interesting thing is that the media attention, the media-driven trading has attenuated post lockdown. So it seems that something happened during the lockdown. It really stepped in, provided liquidity, responded to media, and the effects that I'm going to show you attenuate after the lockdown is ended. All right. So now let's see how this retail trading affected liquidity. So what we're going to do is there's different measures of liquidity. We tried several, all of them give you the same results. So we looked at quoted spread and effective spreads. We looked at price impact. We looked at volume, volatility, daily volatility, all of those. It's all in the paper. I'm going to focus here on effective spread. The average effective spread throughout the day as the measure of illiquidity. So the larger the number, the less liquid the firm is. And what do we see here? When we compare normal and lockdown periods, what do we see? Retail trading, again, this is the log number of unique trading accounts on Robinhood per firm and the end of every given day. That does not have impact on effective spread in the normal period. When you interact retail trading with lockdown, then you see a statistically significant negative number. Let's talk a little bit about economics. What does this 0.041 mean? Well, I think if you want to quantify this, what you need to do is to look at, let's say you want to look at, top versus bottom decile of the distribution. So that's about 3 sigmas, right? 10% versus 90%. So the standard deviation of retail trading is of log retail trading is about 1.8. You take that, multiply by 3. You multiply that by the 41, and then you get a number of about 23 basis points. And if you compare that number to the effective spread of the average firm during the pandemic, that's about 40% of that. So what I would argue is when you go from the low retail trading to the high retail trading firm in the distribution, okay, you're improving the bid-ask spread by about 40% of the average effective spread for a firm during the pandemic. And I think that's huge. What happens when you go from lockdown to reopening? That effect is reversed. So this really happens during the pandemic, and you can see here the effect is reversed. When you add media attention to this, you can see it here. And again, let's focus on effective spread. This is the result we've seen in the previous slide. When you add media coverage and interact it with retail during lockdown, what you see is a positive number. So what this means is that when retailers are trading in response to media coverage, they actually tend to reduce liquidity. Now, the overall effect, the sum of the 37 and the negative 48 is still negative. So I would say what happens when there's significant media attention and everyone goes and tries to trade the same thing, the same asset, what happens is they provide less liquidity on average. Okay, and I think there's several possible explanations for this. And what happened in the end of January of this year is possible explanation. If all of them are reading, Reddit, Wall Street Bets on Reddit, and they're all trading together, that could create a situation of short squeeze, which even reduces liquidity. Another possible explanation is that algorithms are trading the same information. So when there's media coverage coming out and algorithms are trading that, altogether there's going to be increased demand, and you're going to see reduced liquidity. But again, the sum of these is still negative. So the overall effect of retailers is positive, even if you take into account the attention-driven trading. Okay, so at this point, I'm pretty happy that I think I have an interesting result, and I think I'm able to understand these guys are important. However, there's at least two things that one could be worried about. First, I'm looking at just this dummy variable for lockdown and reopen. Now, what I could do is I could take into account the fact that different states open and went into lockdown on different days. And what you see here in this chart, you can see every day in March which state went into lockdown. And as you can see, it's a staggered implementation of this lockdown. So it's not that all of the states went into lockdown at the same time. There was a staggered implementation. So I can use that. Instead of having a dummy, I can have, per state, I can have a different time period. The other issue, of course, is the issue of causality, because all the results I've shown you are contemporaneous regressions. It's a liquidity in a day versus a trading in a day. So one could argue that, well, maybe what's going on is a reverse causality, that when that individuals flow to firms that are more liquid. So even though I don't think that's the case, I'm going to try to prove that I'm going to try to reject that direction. The weakness I have with the data is that with Robinhood, I don't see who's trading. I don't see where they are. So we did a test, and it's a paper still using the Robinhood data. And I'm going to skip that because given the comments that we received from a few individuals in the crowd that pushed us to say, well, maybe you can better identify this. And what we thought we could do is we can use Google searches as a proxy for the retail attention that would eventually, we think, is going to convert to retail trading. So what we could do is we can look at let's say, Google search volume. We can find the volume from every state. So we can see on any given day how much searches were there for every given stock, okay, from each state. So we can have a firm day state variable. And then we can interact that, of course, with the staggered implementation of the lockdown, and that would give us a great, I think, identification. So here are a couple of tables to demonstrate these results. All right, so what do I have here? Here is, remember, there's two types of results. One is let's try to understand, the retail interest or retail trading. So here I'm going to proxy it by Google searches. So let's try to understand Google searches, okay? Local coverage is, instead of looking all media coverage, I'm looking at coverage that is in the local state of where the searches happen. So what you see here is that there's more searches in states that have more local coverage of the firms in these states. Okay, so that's this 0519 t-stat of 1288, very strong result. During the lockdown, there's even more searches. That's consistent with more retail trading. So there's more interest, people search more for firms during the lockdown. That's what you see here. When you interact the local coverage by lockdown, you don't see much. So there is no added effect. So during lockdown, people were responding or searching for firms at the same rate as before the lockdown. So there wasn't any additional marginal response. But then when you flip it and you start looking at illiquidity and you're trying to explain spreads using this state, SSVI is the state search volume index. Okay, there's a SVI, search volume index, where there's state search volume index. And what you see here, what I think is interesting in these results, is that you find that when you look at the state search volume count times lockdown, it's significant. And it seems that, as we showed before, there's when you interact it with local coverage, it's significant as well. So again, the point here is that the negative coefficient suggests that the more searches for the firm during lockdown, the less bid-ask spread, so the more liquidity. So the searches improve stock liquidity. Now, another interesting, I think, aspect of this is what we know as the home bias. So let's, in addition to what I've showed you before, let's also take into account that some firms are headquarters in given states. So the test that I'll try to do is something like this. A state goes into lockdown. Individuals search more for local firms. Okay, so firms that are headquartered in that state. And as a result, liquidity improves. And that's what you see in this table. So the home state dummy here suggests that there's more searches for firms that are local. So there's more state searches for firms that are headquartered in that state. It happens more during lockdown. When you look at the effect on illiquidity, we've seen that more searches during lockdown improve liquidity, but they improve more so for firms that are local. So again, this I think is a really cool result. So again, this is staggered implementation of lockdown. So states that went into lockdown, okay, there were more searches in these states in lockdown on locally, geographically located firms, and that increased stock liquidity. So a few notes before I wrap up. So are these results only pertain to Robinhood? Is Robinhood something specific here? And I think it is the case that Robinhood is important, but it's not only Robinhood. So what we did to try to alleviate this concern is we said, well, let's look at what's the interest or the searches for any of the legacy trading platforms as well. And what you see, there's an increase across the board, quarter over quarter, of interest in the TD, in Ameritrade, in Schwab, in Fidelity. All of those websites have more and more traffic during the pandemic and even after the pandemic. So I think it's not just Robinhood. I think Robinhood is a proxy for a general trend, or what I call the rise in retail trader. Now, I think what I've discussed here, for the most part, are the positive implications for retail trading participating in the market. But even before what we saw in January, we actually wrote in the paper, and thanks, Jared, for mentioning that, we wrote that, well, if retail traders are going to be a significant part in the market, if they have some way to communicate or to coordinate, they can actually impact markets in a way that maybe we still don't understand, and maybe there's going to be some adverse effect. And then January of 2021 happened, and that's exactly what happened. So they went and read on Reddit what people are saying about AMC, about GME, and then the respondent and traded the price up. As a result, we know there's short squeeze, and that I think had the potentially adverse effect on the market. So I think we just need to be aware that there's a new force in the market, and then these are the retail traders. I have here some scripts from media coverage over the last year, and even though I think the average person is not aware that this is an important thing, when you look at banks, they understand that. When you look at all the M&A activity over the last year, Morgan Stanley bought E-Trade, Charles Schwab is buying TD Ameritrade, everyone is hunting for retail investor flow. And so that's a trend in the market, and that's probably going to continue moving forward. So just to conclude, what this paper tries to do is to show that retail traders might have a significant or first-order effect on the market. It particularly looks at provision of liquidity during the pandemic, during the lockdown. I think it demonstrates that that fintech or trading platforms that made it more easier for individuals to trade, they allowed this kind of participation of retail investors, and potentially they alleviated the need for any government intervention during the pandemic, at least in the stock market. And I think in the grand scheme of things, I think the interesting thing for me in this paper is that, it really shows you that, free time matters. When people had time, they started, trading. And I think that could potentially help us understand more about the low participation that we thought it was a puzzle. I think that's, we're understanding that better now. So, I'll stop here and I'm happy to take any questions.